वेलकम टू वीलर्न। वीलर्न में आपका स्वागत है। सब्जेक्ट डायनेमिक एसेट्स मैनेजमेंट, ALM एंड फंड मैनेजमेंट, सेशन नंबर 3 विद स्पेशल रेफरेंस ऑफ बैंकिंग इंडस्ट्रीज। Topic to be covered in this session: what is banking and its provision, risk faced by banks and its effect, ALM factors and concept, liquid assets to total assets, liquidity versus earning, structural liquidity statement, cash flow approaches, RBI guidelines on liquidity risk. What is banking? Section 5B defines banking: accepting for the purpose of lending or investment of deposits or money repayable on demand or otherwise and withdrawable by checks, draft, order or otherwise. Risk taking is an inherent function of banking given by Alan Greenspan. Bank gets affected by action of central bank, action of the government, domestic and international disbursement and inflation. Deregulation: banks are now operating in a fairly deregulated environment and are required to determine on their own interest rates on deposits and advance. Intense competitions for business involving both the assets and liabilities, together with increasing volatility in the interest rate, has brought pressure on the management of banks to maintain a good balance among spreads. Risk faced by bank: there are so many risks faced by bank, like credit risk, market risk, liquidity risk, interest rate risk and operational risk. Effect of risk factor: loss of market value, loss of reserves, loss of stakeholders' confidence from the banking sectors. And now ALM. The ALM guidelines issued by RBI has been formulated to serve as a benchmark for bank which lacks a formal ALM system. Those who already have their existing system may fine-tune their information and reporting system. Purpose of ALM: capture the maturity structure of the cash flows, inflows and outflows in the statement of structural liquidity. Tolerance levels for various maturities may be fixed by the bank, keeping in view bank's ALM profile, extent of stable deposit base, nature of cash flow, etc. Now ALM is about managing market risk and liquidity risk together. Capital market exposure of banks is small, exchange risk is highly specialized. Hence, ALM is an integrated risk management approach for managing liquidity risk, interest rate risk and other same kind of risk which are bearing by the banking sectors or financial institutions. The problems of mismatch: mismatches in maturity, mismatches in interest rate. How does bank makes the spread, borrows short and lend long and keep the spread? Maturity mismatch is the basis of profitability. Risk management does not eliminate mismatch, merely manage them. The problems of mismatch: interest rate risk affect profitability. Liquidity risk may lead to liquidation. General strategy: eliminate liquidity risk, not the mismatch. Manage interest rate risk, consciously create gaps. Assets liability transformation: banks are exposed to credit and market risk in view of the assets liability transformation. With liberalization, banks' operations have become complex and large, requiring strategic management. ALM pillars: ALM information system, ALM organization and ALM process is called ALM pillars. Applicable to scheduled UCBs and Tier 2 UCBs. For Tier 2 UCBs, effective date is December 2008. ALM pillars continue. ALM information system, MIS, information availability, accuracy, adequacy and expediency. These are the ALM pillars. ALM organization, structures and responsibility, level of top management environment, ALM process, risk parameters, risk identification, risk measurement, risk management, risk policies and procedures, prudential limits and auditing, reporting and reviews. And now ALM information system. ALM framework built on sound methodology with necessary information system backup. ALM to be supported by management philosophy and clearly states risk policies and procedures, prudential limits. Banks may utilize gap analysis or simulation. Important to have availability of timely, adequate and accurate information. ALM data could be developed by following approaches. In case UCBs do not have requisite information, analyze behavior of assets and liability, products in sample branches that account for significant business 60 to 70%. Based on this, make rational assumptions for the other branches. UCBs have limited areas of operations and hence it would be easier for them to make such assumptions and better access to data. ALM organization. Board should have overall responsibility for management of risk. Board should decide risk management policy and procedure, set prudential limits, auditing, reporting and review mechanism in respect of liquidity, interest rate and forex risk. ALCO consisting of bank senior manager including CEO, responsible for adherence to the policies and limits set by board. ALM organization responsible for deciding business strategies on assets liability side in line with bank's business and risk objectives. ALM support group consisting of operating staff responsible for analyzing, monitoring and reporting risk profile to ALCO. Prepare forecast showing effect of various possible changes in market conditions affecting balance sheet and suggesting action to adhere to bank's internal limits. ALM organization, ALCO decisions making unit responsible for balance sheet planning from risk return perspective, which include management of liquidity, interest rate and forex risk, pricing of deposits and advance desired maturity profile, etc., monitoring the risk level of the bank, review of the result and progress of implementation of decision made in previous meeting, future business strategies based on bank's current views on interest rate to decide on source and mix of liabilities or sale of assets, to develop future directions of interest rate movement, to decide on funding mix between fixed and floating rate funds, wholesale versus retail deposits, short term versus long term deposits, etc. ALCO size would be dependent on the size of the UCB, may comprise of CEO or secretary, chief of investment, treasury including those of forex, credit planning, etc. Head of IT, if a separate division exists, UCB may at their discretion may have subcommittee and support groups. ALM process. Scope is liquidity risk management, interest rate risk management, trading price risk management, funding and capital management, profit planning and business projections. UCBs generally are not exposed to forex risk. ALM liquidity risk, interest rate risk, and now liquidity rate risk. arising due to overextension of credit, high level of NPAs, poor assets quality, mismanagement, hot money, non-recognition of embedded option risk, reliance on few wholesale depositors, large undrawn loan commitment, lack of appropriate liquidity policy and contingent plan. Bank must be in a position to balance their need for liquidity with their need for earning. More liquid assets tends to provide lower return than do less liquid assets. Assessing liquidity position. Assessing a bank's liquidity positions can be challenging, and adequate positions for one bank may not be sufficient for another. A position considered adequate for a bank in one time period may not be so in another. Bank specific and dynamic. Liquidity risk manifestation. Funding risk need to replace net outflows due to unanticipated withdrawal, non-renewal of deposits. Time risk need to compensate for non-receipt of expected inflows of fund performing assets turning into non-performing assets. Liquidity risk measurement. Two methods are employed: stock approach, employing ratio, flow approach, time buckets analysis. Liquidity risk measurement, liquidity ratios, volatile liability dependence ratios, volatile liability minus temporary investment to earning assets net of temporary investment shows the extent to which banks reliance on volatile fund to support long-term assets. Where volatile liabilities represents wholesale deposits which are market sensitive and temporary investment are those maturing within 1 year and those investment which are held in the trading book and are readily sold in the market. Growth in core deposits to growth in assets, higher the ratio the better. Purchase fund to total assets, where purchase fund include the entire interbank and other money market borrowing including certificate of deposits and institutional deposits. Loan losses to net loan, loan to core deposits does not leads to proper assessment of liquidity gap due to liquidity of liquid assets, their ready marketability, difficulty to convert easily into liquid cash with least loss of value from the previously quoted market rates. Liquid assets to total assets. Liquid assets to total assets shows the percentage of liquid assets in the asset structure of the bank, which is 18 to 20%. Liquid assets generally are cash balances with RBI plus balances with other bank plus investment available for sale plus money market instrument. Liquid assets to total deposit. This ratio indicates extent of liquidity maintained by a bank for meeting the demand made by the depositors, sometimes taken as a measure of bank liquidity 20 to 20%. Loans to deposits. Loans to deposits, loan to deposit ratio indicate the degree to which the bank has already used up its available resources to accommodate the credit needs of the customers. A high loan deposit ratio indicates that a bank will have comparatively low liquidity. Loans to assets. Loan to assets, this ratio indicates the percentage of illiquid assets to total assets. A range in this ratio would indicate lower liquidity. Loan to core deposits. Loan to core deposits, those deposits which are not subject to any large volatility. Average level of previous years deposit is generally taken as core deposits. This ratio helps in assessing level of deployment of core portions of deposits. Loan to investment. Loan to investment, while loans provide higher returns compared to investments. These suffers from credit risk and are more illiquid than investment. A proper mix of loan and investment, keeping in view liquidity and yield consideration, need to be fixed. Cash flow approach. Preparing a structural liquidity by taking into account balance sheet on particular date and place in maturity ladder according to time buckets. Identify the liquidity needs to evolve methods to meet it. Negative gaps in individual time buckets indicate the needs. The need could be controlled by prudential limits as also by regulating the basis of business structure, financial flexibility of the bank. Regulatory limit of 20% on outflows in first two time buckets. RBI guidelines on liquidity risk. Methodology prescribed in ALM system, structural liquidity statement and dynamic liquidity ladders are simple. Need to make assumptions and trend analysis, behavioral maturity analysis, variance analysis at least once in 6 months and assumptions fine tune. Track the impact of exercise of options and potential liquidity needs. Cap on interbank borrowing and call money. Structural liquidity statement schedules UCBs, SSL layout. Circular September 17, 2004 schedule UCBs. More granular approach adopted by splitting first buckets of 1 to 14 days in SSL into next day, 2 to 7 days and 8 to 14 days. Net cumulative negative mismatches during the next days 2 to 7 days, 8 to 14 days and 15 to 28 days buckets should not exceed 5%, 10%, 15% and 20% of the cumulative cash outflows in the respective buckets. Bank may undertake dynamic liquidity management and should prepare the SSL on daily basis to top management ALCO. SSL may be reported to RBI at fortnightly intervals within 10 days of the reporting Friday. Revised format would be applicable from January 1, 2009. UCBs in Tier 2 are also covered. Scheduled UCB to report structural liquidity positions and interest rate sensitivity to RBI as part of OSS data. Structural liquidity statement scheduled UCB. Head of accounts outflows, the capital reserve and surplus over 5 years band, demand deposit current and saving, volatile and core deposit saving 10% and current 15% are withdrawable on demand generally and hence volatile. Volatile portion in 1 day, 2 to 7 days and 8 to 14 days depending upon the experience and estimates of bank and rest core portions in over 1 to 3 years time band. It is only a benchmark if the system is better developed, can classify based on behavioral instead of contractual maturity. Terms deposit respective maturity buckets, appropriate time band can be given based on behavioral instead of contractual maturity. However, wholesale deposit over 15 lakhs should be shown in respective residual time band. CDs or certificates of deposits classified into time bonds, respective maturity buckets, other liabilities, bills payable, core component which would be estimated on the basis of past data and behavioral pattern in over 1 to 3 years time buckets, balance in days 1, 2 to 7 days and 8 to 14 days time band. Provisions other than for loan, loss and depreciation investment, respective time bands, item not representing cash payable, guarantees, fees received in advance, etc. may be placed in over 5 years time band. Export refinancing availed respective time band of underlying assets. Structural liquidity statement. Inflows, cash, days 1 buckets, balance with RBI, PSU bank, SCB and DCCB, etc. Access balance over required CRR, SLR under day 1 vacates, the statutory balance distributed in different time bands corresponding to the maturity profile of DTL with 14 days timeline. Balance with other bank, current account, non-withdrawable portions on stipulation of minimum balance in 1 to 3 years band and remaining balance in 1 day vacates band. Money at call and short notice respective residual maturity band. Then investment, approved security, respective residual time band except amount of required to be reinvested for maintaining SLR and CRR. PSU bonds, CDs and CPs, units of UTI, close-ended, etc. Residual maturity, investment classified as NPAs in 3 to 5 year band, substandard and over 5 years doubtful. Equity of all India and financial institutions, etc. Listed shares in 2 to 7 days vacates with haircut of 50%, other shares in over 5 years vacate. Unit of mutual fund and security and trading books, day 1 vacates, and day 1 vacates 2 to 7 days, 8 to 14 days, 15 to 28 days and 29 to 90 days according to differences period. Investment subsidiaries over 5 years vacate. NPAs, substandard 3 to 5 years band, doubtful and loss over 5 years band, fixed assets over 5 year bands, other assets and tangible assets. Intangible assets and assets not representing cash flows may be shown in over 5 years vacate. Contingent liability LC guarantees outflow, assets created out of development may be shown under respective maturity vacates on the basis of probable dates of recovery. Lines of credit committees or committed lines of credit committed to from institutions and export defines unavailed portions of cash credit, overdraft, etc. Day 1 vacates based on behavioral pattern and seasonal pattern arrive at potential availment and put under relevant maturity vacate up to 12 months. Repo, etc. based on respective residual time bonds, interest payable respective time bond bands, structural liquidity statement, liabilities on account of event cash flows, CRR, SRR, shortfall with settlement and any other contingency under respective maturity band, all overdue liabilities in day 1 to 7 days and 8 to 14 days vacates based on behavioral estimates. Interest and installment from advances and investment which are due for less than 1 month, 1 to 6 month time band. Interest and installment from advances and investment which are overdue for less than 1 month may be placed in day 1, 2 to 7 days and 8 to 14 days based on behavioral pattern. Further interest and installment due before classification as NPA may be placed in 29 days to 3 months vacates if the earlier receivables remain uncollected. And now do it yourself. What is ALM, how it is managed, and what is cash flow approach? And that's it from session number 2. Thank you.